Hello, and welcome to this podcast on ASU 2012-02 for the impairment testing of indefinite-lived intangible assets, which allows entities to make a qualitative assessment when performing their impairment test. My name is Kevin Slama, and I'm a senior manager in KPMG's Department of Professional Practice. I'll be providing an overview of the guidance in the new ASU, discussing a potential process to perform the qualitative assessment, and addressing some of the factors to consider in performing the qualitative assessment. The qualitative assessment option for indefinite-lived intangible assets is a follow-up to ASU 2011-08 on testing goodwill for impairment. In the development of that ASU, many commentators suggested that a qualitative assessment would also be appropriate for indefinite-lived intangible assets due to the similarities in the factors affecting their fair value from period to period. The result was the issuance of ASU 2012-02 on July 27, 2012, permitting entities to make a qualitative assessment when evaluating indefinite-lived intangible assets for impairment. One of the main objectives of the ASU is to reduce the cost for both public and non-public entities in performing their required annual impairment assessment for indefinite-lived intangible assets. This is achieved by allowing management to first perform a qualitative assessment to determine whether it is more likely than not that an intangible asset is impaired, which exists when the carrying amount of the asset exceeds its fair value. Companies would only be required to perform a quantitative fair value calculation for the impairment test when it's more likely than not that it's impaired. In other words, the quantitative fair value calculation would only be required when it's more than 50% likely that the asset is impaired. The qualitative assessment is optional and exists on an asset-by-asset basis, so an entity may choose to apply the qualitative assessment for all of their indefinite-lived intangible assets, some of them, or none of them in any period. Additionally, it can elect each period whether or not it wants to perform a qualitative assessment. There are no specific requirements in the ASU on exactly how to do the qualitative assessment, other than that management needs to consider all of the relative facts and circumstances that could impact the fair value of the intangible asset. The extent and effort needed to support a conclusion based on the qualitative assessment will depend on the specific facts and circumstances. In some cases, that conclusion may be very clear with relatively little effort when all relevant factors are trending positively, but in other cases, when the conclusion becomes less clear, additional effort and documentation may be necessary, or management may determine that it needs to bypass the qualitative assessment and go straight to the quantitative analysis. Although there are no specific requirements or steps outlined in the ASU to perform the qualitative assessment, it's clear management will need to have some process in place to support its conclusions regarding potential impairment, since management is required to make a determination on at least an annual basis whether or not indefinite-lived intangible assets are impaired. Additionally, having a clearly defined process in place may help to make the analysis as efficient as possible for both the initial adoption of the new standard and in applying the standard on an ongoing basis. We've developed one example of a potential process for consideration that I'll walk you through that could be applied by an entity in the assessment. The example consists of 7 steps, and again, this is just for illustrative purposes to think through. It's not a requirement of the standard, nor are we saying that management has to apply the 7 steps in the way that I described them. Step 1 is to consider for which indefinite-lived intangible assets to perform a qualitative assessment and which to proceed directly to a quantitative impairment test. For example, in-process research and development, or IPR&D for short, is within the scope of this ASU, so it is permissible to use a qualitative assessment for the annual impairment test. However, in paragraph 12 of the basis of conclusions for the ASU, it talks about IPR&D being somewhat difficult to value because there are a lot of uncertainties around it. So it might be a situation where if you had an IPR&D asset, because of the uncertainties inherent in its valuation, the company might conclude that it's going to be more efficient to go to the quantitative test for that. Now again, that's not a hard and fast rule. That's something that entities would want to think about. Another consideration in determining whether to perform the qualitative assessment is the length of time since the most recent fair value determination and the amount of cushion between the intangible asset's fair value and its carrying amount as of the last valuation date. So step 2 is to consider any recent fair value measurements and when that measure was performed. One of the key questions to ask at this point is how much cushion was there between the fair value of the intangible asset and its carrying amount? When there's more cushion, there's more opportunity for any negative factors to allow the fair value to absorb changes without triggering an impairment loss. However, as the difference between the fair value and carrying amount gets smaller, changes in events and circumstances may be more likely to have a significant impact on the impairment conclusion. Additionally, the longer the quantitative assessment was made, the less weight the previous cushion will have on the analysis. Of course, there are not bright lines, and the weighting will depend not only on how long ago the quantitative measure was made, but also on the stability or volatility of the fair value measure. For example, for IPR&D, because it's highly susceptible to a number of risks, it's likely that a quantitative assessment will be needed more frequently than for a well-established brand that has been established in the marketplace for decades and continues to flourish. Step 3 is to identify the key drivers used in the fair value measurement for each indefinite-lived intangible asset. Since we're trying to qualitatively address what the fair value of the intangible asset is, a key question is definitely going to be, what are the drivers of the fair value measurement for that intangible? Some example approaches to identify the key drivers would be to understand the key assumptions from recent fair value measurements and what has happened to them. For example, is the value closely aligned with interest rates, oil costs, royalty rates, foreign exchange and international trade, or the entrance and exit of competitors? Also, if the qualitative assessment was for an indefinite-lived trade name, it's likely the relief from royalty method was used in the fair value measurement. So the key drivers would likely include forecasted revenue, the discount rate, or the royalty rate. Step 4 is to identify events and circumstances that have occurred that may have impacted the key drivers for the fair value measurement. The ASU identifies several factors to consider that may impact the fair value, which we'll look at in more detail after we've finished walking through the example process. The key to evaluating the factors from the ASU or other relevant events and circumstances specific to the entity or the indefinite-lived intangible asset is to identify what's occurred since the last evaluation date that could impact the drivers of fair value. And you want to make sure you're considering all the factors, both positive and negative, as well as mitigating factors in the analysis. In our trade name example from Step 3, we'd want to understand what factors have likely impacted our forecasted revenue and how actual revenue is tracking against the forecasted revenue, discount rates, and royalty rates. Step 5 is to assess the potential impact of the factors identified in the previous steps on the fair value of the indefinite-lived intangible asset. This step is really where we're pulling together the results of the 4 previous steps and coming to a conclusion on how fair value has been impacted, either negatively or positively. Step 6 considers any transactions or events that impacted the carrying amount of the intangible asset. One of the changes to the carrying amount that's the easiest to understand is when there's been a recent impairment, and if that's the case, it may be easier to skip the qualitative assessment and go directly to the quantitative fair value measurement. Another reason for a change in the carrying amount, though, could be because of how an entity defines the unit of account for testing purposes. In some cases, it may be appropriate to combine 2 or more indefinite-lived intangible assets for testing purposes, and this could impact the carrying amount from period to period if there's a change in how the unit of account is defined or the number of intangibles included in the unit of account, such as if there's an acquisition during the period that includes an indefinite-lived intangible asset that will be grouped together with other similar intangible assets into the same unit of account. Step 7, the last step in our illustrative process, is to document the final conclusions reached as to whether the entity believes, based on the assessment of qualitative factors, it can support a conclusion that the intangible asset is not impaired, or whether it thinks it is more likely than not the intangible asset is impaired and that a quantitative assessment is necessary. The level of detail required in the documentation will vary depending on each entity's particular fact pattern, which could be impacted by the amount of cushion between the fair value and carrying amount based on recent quantitative tests. It will also be impacted by the weight of positive versus negative indicators to fair value. For example, if the overall economy, the entity's competitors, and the entity itself are performing well, and there are a series of positive indicators to point to without a lot of negative indicators, there may not be a need for an extensive documentation. Overall, management has to evaluate the totality of the evidence in order to support its more likely than not assessment, so the amount of the documentation is going to depend on how much judgment there is required in the assessment. In our discussion of Step 4, where we identify the events and circumstances that have occurred that may have impacted the key drivers for the fair value measurement, I mentioned that the ASU includes several factors to consider. These factors include cost factors, financial performance, legal, regulatory, contractual, political, business, or other factors, including asset-specific factors. other relevant entity-specific events, industry and market considerations, and macroeconomic conditions. Cost factors include such things as increases in raw materials, labor, or other costs that have a negative effect on future earnings or cash flows. Financial performance could include things such as negative or declining cash flows, or a decline in actual planned revenue or earnings compared with the actual results of relative prior periods. The next grouping is legal, regulatory, contractual, political, business, or other factors. Other relevant entity-specific events could include things such as changes in management, key personnel, strategy, or customers. It could also include the contemplation of bankruptcy or litigation. Industry and market considerations could include things such as a deterioration in the environment of which the entity operates, an increase in the competitive environment, a decline in market-dependent multiples, or a change in the market for an entity's products or services. And lastly, macroeconomic conditions could include things such as a deterioration of general economic conditions, limitations on accessing capital, fluctuations in foreign exchange rate, or other developments in equity or credit markets. These factors that we've discussed replace the references to the indicators of impairment in ASC 360 for property, plant, and equipment, and should also be used to evaluate whether a triggering event has occurred that would require an entity to make an impairment assessment as of an interim date. Remember, while the ASU provides a hopefully more cost-effective way to test indefinite-lived intangible assets by allowing a qualitative assessment, the requirement to perform an annual test, or more often if indicators of impairment are present, has not changed. The ASU is effective for annual and interim impairment tests performed for fiscal years beginning after September 15, 2012, and early adoption is permitted, including for periods prior to the issuance of the ASU if financial statements have not yet been issued or made available for issuance for certain non-public entities. This concludes the podcast ASU 2012-02 for testing indefinite-lived intangible assets for impairment using a qualitative assessment, which has hopefully provided you with an understandable overview of the new standard. If you'd like additional information on the topic, please visit KPMG's Financial Reporting Network for the latest on this topic and others impacting financial reporting requirements.